Greetings and a warm welcome to everyone tuning in today. We find ourselves in the midst of a digital revolution, with digital currencies taking center stage. Imagine a world where physical money as we know it becomes obsolete, replaced by a new form of currency that exists purely in the digital realm. This isn't a distant future, but a rapidly materializing reality. Digital currencies are not just a trending topic, but a significant evolution in the financial landscape. They have been steadily gaining traction, reshaping how we transact, invest, and view money. Central to this revolution are the world's leading financial institutions, the banks, who are feeling the pressure to adapt and innovate. The creation of their own central bank digital currencies, or CBDCs, is one such innovation. Today, we delve into an intriguing aspect of this revolution: banks creating their own digital currencies. You might be wondering why banks, traditional bastions of finance, are venturing into digital currencies. Well, let's dive into that. Firstly, central banks around the world are under considerable pressure to create their own central bank digital currencies, or CBDCs. This pressure isn't just coming from within the finance sector, but also from the ever-evolving world of technology. With the rise of digital transactions, the traditional cash-based system is slowly fading into the background. Banks need to adapt to this change and keep up with the tech-driven times, or risk being left behind. Another driving force is the changing financial landscape. Cryptocurrencies like Bitcoin and Ethereum have taken the world by storm. They've shown that digital currencies can work and have value. While these cryptocurrencies operate outside of traditional banking systems, they've made many people comfortable with the idea of digital money. In response, banks are exploring the creation of their own digital currencies to maintain control and relevance in this digital era. Moreover, the development of CBDCs isn't just about keeping up with the times, it's also about innovation. Digital currencies offer a new way of doing things. They can make transactions faster, more efficient, and more accessible, especially for those who are unbanked or underbanked. But it's not all about the banks. Countries, too, are interested in CBDCs. They see these digital currencies as a way to maintain monetary sovereignty in a world where private cryptocurrencies are becoming increasingly popular. Additionally, CBDCs can provide governments with more control over their economies, allowing them to better manage inflation and economic stability. However, it's not all smooth sailing. The development of CBDCs comes with its own set of challenges, from technical hurdles to regulatory issues, and that's not even mentioning the potential impact on privacy and freedom. So it's a blend of necessity and innovation that's driving banks towards this new frontier. But as we'll see in the next scenes, this journey is fraught with both opportunities and risks. With banks stepping into the realm of digital currencies, there are some distinct advantages to consider. Let's start with financial inclusion. Traditional banking systems can often exclude individuals and businesses that lack access to physical branches or the necessary documentation for opening accounts. Digital currencies, on the other hand, can be accessed and managed using a simple smartphone, making it easier for people in remote areas or those without traditional banking access to join the financial system. Then there's the improved payment efficiency. Digital currencies can be transferred instantaneously at any time and anywhere. This eliminates the need for intermediaries, reduces costs, and speeds up transactions. Think about how this could revolutionize international remittances, where high fees and lengthy transfer times are currently a norm. Another potential advantage is in the realm of monetary policy. Central bank. Digital currencies, or CBDCs, could offer an unprecedented level of control and flexibility for central banks. For instance, during an economic downturn, banks could inject digital money directly into consumer accounts to stimulate spending. This could be a game changer, offering a new tool for managing inflation and economic stability. But it's not just about the macro-level benefits. For consumers, digital currencies could mean faster, cheaper, and more secure transactions. For businesses, it could mean smoother international trade, lower costs, and new opportunities for innovation. Additionally, digital currencies could help in reducing financial crimes. With the traceability of digital transactions, it becomes harder for illicit activities to go unnoticed. This could lead to a significant reduction in money laundering, fraud, and other financial crimes. It's also worth mentioning that digital currencies could provide a competitive push for banks, encouraging them to innovate and improve their services to keep up with the digital trend. This could lead to a more dynamic and customer-focused banking sector. It's clear that the digital currency revolution has the potential to bring about significant benefits. From financial inclusion to efficient payments, better monetary policy and reduced crime, the advantages are compelling. These benefits make a compelling case for banks to embrace digital currencies. But as with any innovation, there are potential pitfalls and drawbacks to consider. For all the promise of central bank digital currencies or CBDCs, there are a number of potential downsides that warrant our attention. One of the most significant concerns is privacy. In a world where digital currencies are the norm, every transaction could potentially be traced and monitored. This raises serious questions about financial privacy and the potential for misuse of information. While proponents argue that digital currencies could help combat fraud and money laundering, critics worry about the potential for overreach and abuse of power. Next, we have to consider the cybersecurity threats. As we've seen with recent high-profile cyber attacks, no system is completely safe from hackers. Digital currencies, with their reliance on complex technology, could potentially be a prime target. If a central bank's digital currency was to be compromised, the implications could be catastrophic, leading to a loss of trust and potentially destabilizing the entire financial system. Moreover, the introduction of CBDCs could lead to a profound shift in the banking landscape. Today, commercial banks play a crucial role in the money creation process. However, if central banks were to issue digital currencies directly to the public, it could potentially bypass the need for commercial banks. This could lead to a destabilization of the traditional banking system as we know it. But perhaps the most significant risk lies in the transition period. Moving from a traditional monetary system to one dominated by digital currencies would be a complex and potentially turbulent process. If not handled correctly, it could lead to financial instability and even economic crises. In conclusion, while the potential benefits of digital currencies are significant, the risks cannot be ignored. These challenges highlight the delicate balancing act banks must perform in their journey towards digital currencies. It's a thrilling yet perilous journey that will require careful navigation to ensure the stability and security of our financial future. While this is a global trend, some countries are notably ahead of the game. Let's turn our attention to the East, where China has been rapidly developing its own digital currency, the Digital Currency Electronic Payment or DCEP. They've already started trials in several cities, pushing the envelope in this financial revolution. Then we head up north to Sweden, a nation known for its digital savvy. The Riksbank, Sweden's central bank, has been piloting its own digital currency, the e-krona. With cash usage dwindling in the country, Sweden is primed to transition into a cashless society. This isn't just a two-horse race, though. Other countries, such as South Korea and the Bahamas, are also testing their own digital currencies. It's a fascinating time as we see these nations rewrite the rules of finance. These countries are setting the pace in this digital currency race. But what does all this mean for you, the person on the street? As banks continue to dive into the digital currency pool, there are several potential implications for the average consumer. For starters, the digitization of currency could open up easier access to banking services. No longer would a physical bank or ATM be required for transactions. With a smartphone and internet connection, the world of banking could be at your fingertips. Additionally, transactions could become faster and cheaper. The speed of digital transactions could outpace the traditional banking system, and without the need for intermediaries, costs might be cut significantly. However, this all comes with a caveat. The shift to digital currencies also necessitates an increased need for digital literacy. Understanding how to safely and effectively navigate the digital financial landscape will become more critical than ever. So, the shift to digital currencies could bring about a mixed bag of outcomes for the average consumer. As we navigate these uncharted waters, one thing is clear: the world of finance is changing, and digital currencies are at the heart of that change. We've delved into why banks are feeling the pressure to create their own digital currencies. And we've seen both the potential benefits and potential pitfalls of such a move. We've also highlighted the countries that are leading the pack in this digital revolution and the implications for us, the everyday consumers. If there's one thing to take away from this, it's that the landscape of finance is evolving, and it's crucial for us to stay informed and adaptable. This isn't just about banks or countries. It's about how we as individuals navigate our financial futures in an increasingly digital world. Thank you for joining us on this exploration of digital currencies. Don't forget to subscribe and hit the bell sign for more exciting content. Until next time, keep exploring the world of finance.